Welcome to the Stock Market Palantir. Today, we are going to talk about, well, a really interesting one, RDDT.
Mm-hmm. Definitely a contentious one.
It is. We're looking at what is, I think, one of the most compelling and frankly conflicted stories in the market right now. You have a stock that's currently trading robustly in the, $220 to $230 range as of December 2025.
Right. A massive appreciation from its $34 IPO price. It's been an incredible run.
Exactly. But at the same time, the trading mechanics are telling a very complex counter-narrative. The data showing persistently high volume, with somewhere between 55 and 65% of daily activity happening off-exchange, away from the lit markets.
Yeah, in the dark pools.
So the core conflict for us today is this divergence between Reddit's, explosive fundamental transformation, this pivot AI data infrastructure, and crucially, profitability, and this deep structural market skepticism. It's rooted in, aggressive insider selling and these really complex trading dynamics.
So the question for investors is pretty stark. Is this premium valuation justified because Reddit is now the landlord of the AI internet? Or is the price action just dangerously dependent on some very high-risk market dynamics?
And I'll be arguing that the fundamental re-rating we're seeing, which is driven by that AI revenue and profitability, is irreversible and it completely justifies the current price.
And I'm going to argue that while, yes, the fundamentals have undeniably improved, the structural dynamics in this significant governance paradox from the insider selling, they introduce what I see as intolerable risks. It suggests the valuation is really optimized for executive liquidity, not long-term stability.
Finally giving RDDT the respect it deserves. It's no longer just another volatile social media company you might, lump in with Snap. It's transitioning into a high-margin AI data infrastructure provider, and the valuation reflects that scarcity. We see the stock trading at, 13 times price to sales, which is high, and critically, 88 times forward price to earnings. That PE multiple is clearly pricing in some explosive, sustained growth. And the evidence for this shift became, frankly, undeniable in the third quarter of 2025. That was the historic pivot, $163 million in net income. That single number, combined with a 68% year-over-year revenue surge, it just dismantled the named bear case that RDDT was, chronically unprofitable. Their move to lock down the API and sign these lucrative licensing deals, like with Google, it transforms 19-plus years of human conversation into a powerful, high-margin revenue stream. They're projecting it'll reach $400 million by 2027. This data scarcity is the asset. It's irreplaceable. And that's what's driving the premium.
That is certainly a powerful narrative. And I agree, the pivot is very clear. But I struggle to reconcile that strategic vision with the internal actions. The dissonance you get from this governance paradox introduces profound risks, and it suggests this valuation is right now really serving insider liquidity. I mean, just look at the filings. The insider selling is aggressive, it's systematic, and it's relentless. The CEO, Steve Huffman, he alone has executed 1051 plans to liquidate over 500,000 shares in just the last half of 2025. That's nearly $68 million.
Right.
And this selling has been met with zero, absolutely zero, corresponding open market purchases by any major executive. To the average retail investor on their platform, this looks like a textbook pump and dump. And that high off-exchange trading volume, the 65%, it just confirms a market structure that, it facilitates this kind of liquidity with very thin price discovery on the open exchange.
Okay,
So let's start the core challenge right there. With the governance issue, I understand the legal defense of a 10b5-1 plan. I do. But we have to acknowledge the signal that $68 million in systematic liquidation sends. How can institutions justify adding to a position at this price when the very people who know the company best see the valuation as, quote, an excellent exit point? The skepticism and that powerful trader narrative you see all over Wall Street Bets, which is ironically their core user base, it's perfectly rational. The optics aren't just bad, they represent a fundamental disconnect between executive faith and investor trust. You can't just ignore that sentiment risk.
I agree the optics are terrible. Of course they are. And the timing of the sales has been, well, extremely unfortunate, especially given the stock's run-up. But we have to be diligent here and separate market sentiment from, financial legality and necessity. The sales are entirely pre-scheduled and automated under the 10b5-1 mechanism. That structure is designed specifically to prevent insider trading. It mandates sales far in advance, regardless of what the price does later. Huffman's plan, for example, was set back in May, months before the price surged. For a founder whose personal wealth is almost entirely tied up in one volatile stock, rational diversification is just a fiduciary necessity for their own estate planning. So to characterize this legal, structured diversification as a total loss of conviction is a misreading of executive personal finance. What actually defines conviction is the business reality. The 40% adjusted EBITDA margin, the massive growth, that's what should anchor institutional investment, not the optics of one person's liquidity.
I see why you rely on the technical defense of the 10b5-1, but let's talk about the scale and the frequency of it. When hundreds of millions of dollars of executive equity are systematically moving out of a stock, the quantity itself goes from being prudent diversification to a structural headwind on supply. It raises an uncomfortable question. If the future is so bright and that AI moat is so valuable, why is zero new capital being put in by those closest to the engine? Zero executive open market purchases. That suggests they don't believe the stock is undervalued, even at these prices. This persistent supply overhang of liquidating insider shares means that every new institutional dollar coming in is fighting against the tide of founders and executives heading for the exit. That weakens the floor under the price.
That's a powerful point on the supply dynamic. But does that supply dynamic really move a $220 stock, or do the fundamentals? Let's get back to what's really driving this price, the AI data moat. The high 88 times PE is not just some speculative number, it's a direct valuation response to the scarcity of high-quality, human-generated training data for large language models. This isn't just web-scraped text. This is 19 years of nuanced, contextual, and often highly specialized human conversation. The market is pricing this asset extremely aggressively because the supply is finite and RDDT has successfully locked itself down, making itself the exclusive vendor.
And let me just elaborate on the economics of that $400 million projection. That data licensing revenue is almost pure profit. We are talking your 100% gross margin because the data collection costs, they've already been paid over the last 2 decades. The difference between $1 of data revenue and $1 of ad revenue is just massive. Advertising dollars require constant engagement, sales teams. Data licensing is a high-volume, low-effort revenue stream that flows straight to the bottom line. Because of that, the market correctly applies a much higher multiple, maybe 5 to 10 times more, to that data stream than it would to ad revenue. That scarcity value fundamentally justifies the premium.
I agree that the data moat is real. The margin potential is immense. I don't dispute that. But I would frame the valuation risk differently. The company's dual-class share structure undermines the realization of that value for public shareholders. The Class B stock held by insiders carries 10 votes per share. That gives the founding teams entrenched control. It effectively renders public Class A shareholders powerless in any major corporate governance dispute, like, say, challenging executive compensation. This dual-class structure, combined with aggressive insider selling, it creates a toxic feedback loop. Institutional money demands robust governance. When you have entrenched control being used to facilitate massive liquidation, it limits institutional commitment, and it reinforces the retail view that the platform is just a cash grab for insiders, not a long-term partnership.
But institutional investors are sophisticated enough to model for a dual-class structure. They do it for Meta, they do it for Google. It's not a new concept. The strategic advantage of that structure is that it allows long-term visionary leadership, like Huffman's, to execute massive, disruptive pivots, like this one, into an AI provider, without being derailed by short-term activist shareholders who are only focused on the next quarter's earnings. The governance structure is designed to support the long-term data moat strategy, which is precisely what we're betting on here.
That assumes optimal governance. But when control is absolute and the selling is persistent, it severely limits the options for public shareholders if execution falters. Let's move on, though, and focus on what I think is the most immediate structural risk, the market mechanics. the high percentage of off-exchange volume, 60% or more, it confirms that true liquidity and stable price discovery are structurally impaired.
Okay.
Let's get technical for a second about this off-exchange volume. The off-exchange short ratio is consistently above 60%, and we've seen moments of extreme liquidity stress, specifically spikes in fails to deliver, or FTDs. For example, on October 21st, 2025, we saw 154,000 FTD shares. That's $31 million in unsettled trades. An FTD is basically a trade that failed to settle. When the price is rising this fast, these unsettled positions often trigger mandatory closeouts. This suggests that the rapid appreciation in RDDT's price, that surged from 180 to 220, has been silently fueled not just by new buying, but by structural short covering and mandatory buy-ins needed to clear those FTDs. This mechanical instability means the rally relies heavily on cleaning up prior trading imbalances, which makes the current price potentially fragile.
I'm just not convinced by that line of reasoning. I think it generalizes the implications of off-exchange trading, and it overstates the impact of some isolated FTD spikes. High off-exchange volume is a systemic feature, not a bug, for a retail-heavy stock like this. It is structurally consistent with PFOF. The vast majority of retail orders are routed by brokers to internalizers, the dark pools for execution. And those market makers are providing better execution prices for small orders, which accounts for that 60% volume. That volume is the harmless aggregate of thousands of small retail trades, not some nefarious institutional block trade.
But the mechanism itself matters.
But furthermore, while FTDs are an issue, the idea that they were the primary engine for a $40 surge, it just ignores the massive fundamental catalyst. The price surge wasn't a mechanical short squeeze triggered by 31 million in unsettled trades. The rally was initiated and sustained by the Q3 earnings beat, reporting 585 million in revenue and 163 million in net income was a material, fundamental shock to the entire market. It forced bears to capitulate. The stock re-rated because the profitability thesis was proven, and that fundamental shock vastly outweighs isolated volatility from settlement failures.
But the mechanism matters when you're assessing risk. PFOF, while it might be efficient for the retail trader, fundamentally removes that volume from the lit exchange, and that contributes to the thin price discovery we talked about. If true institutional conviction were really that strong, we would see far more block trading on the NYSE or NASDAQ floor, not 60% of the volume internalized by wholesalers. The market structure therefore acts as an amplifier for volatility. It makes the stock highly reactive to sentiment swings because genuine institutional accumulation is obscured, and the price is more easily moved by concentrated retail flow or, as I argued, those structural pressures like forced buy-ins. It creates a stock that can run hot and fast, but its floor is fundamentally weaker than a stock with deep, visible institutional liquidity.
And my contention remains that while the structural may amplify volatility, it cannot create $163 million in net income. That financial reality is the long-term anchor. The structural volatility is a short-term trading risk. The AI data moat and profitability are a long-term capital preservation and growth driver. The question for an investor is just how long they're willing to stomach the structural noise while the core business transforms. To summarize my position, the transformation of Reddit into a sophisticated AI data infrastructure play is now a reality. It's evidenced by the financial statements. This shift is solidly backed by massive profitability and powerful international growth, that 31.4% year-for-year surge in international daily active users. The long-term trajectory is defined by its irreplaceable data moat, not by the optics of executive diversification or the short-term noise of the trading tape.
And conversely, my summary is that the market structure and the cognitive dissonance between the executive selling and the public buying introduce a high, unnecessary degree of structural risk. The stock's price action is a perpetual battleground where strong corporate fundamentals are clashing directly with weak corporate governance and opaque market structure dynamics. This heavy reliance on off-exchange mechanics and the persistent signal sent by that 68 million in executive liquidation demand that investors exercise extreme caution and recognize the fragility that is underpinning this current price.
I think that's fair.
RDT presents a unique challenge where the strongest arguments for its long-term viability, the AI data, the hard-won profitability, exist right alongside these profound structural and sentiment risks. The material clearly shows the outcome really hinges on whether you prioritize the clarity of the financial statement or the ambiguity inherent in the trading structure.
Exactly. We have fundamental strength fighting structural weakness, and the question for any investor is which force will ultimately dominate the share price going forward.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.